Here's the story they never tell you about the Federal Reserve and the Great Depression. The official narrative says the Fed caused the crash by squeezing the money supply too hard, but that explanation has a fundamental problem that changes everything once you see it. The Fed in 1928 was far too weak to cause much of anything, and the evidence for this institutional impotence is overwhelming. This is a complex story that spans decades and reveals patterns most people never notice, so I'm breaking it into two parts. What you're about to discover in this first part will fundamentally change how you see the relationship between crisis and power. This institution that supposedly controlled American finance was actually being laughed at by Wall Street traders who viewed it as bureaucratic theater. Consider what was happening in 1928, when the Federal Reserve had been around for exactly 16 years and still couldn't get banks to follow its guidance. Banks across America would receive policy memos from Fed officials in Washington and immediately throw them in the trash because joining the Fed was optional, and following their rules was even more optional. The Fed could write letters, hold meetings, and issue stern warnings, but they couldn't actually force anyone to do anything meaningful. The numbers revealed just how fragmented the system really was. 40% of American banks operated completely outside Federal Reserve control, with thousands of state-chartered banks answering to state regulators rather than the Federal Reserve. The national banking system had a massive blind spot, and everyone in the industry knew it created vulnerabilities that nobody had the authority to address. The regional structure made everything dramatically worse because the Fed wasn't even functioning as one institution. It was 12 separate regional banks operating like independent kingdoms, with New York tightening credit while Chicago loosened it, creating policy chaos that confused markets and undermined any sense of unified authority. Fed officials in different cities would openly contradict each other in newspaper interviews, making it impossible to discern what Federal Reserve policy actually was at any given moment. Wall Street traders treated the Fed like an inconvenient joke, viewing it as bureaucratic theater put on by politicians who fundamentally didn't understand how markets actually worked. When Fed officials issued increasingly desperate warnings about excessive speculation in late 1928 and 1929, financial newspapers covered these announcements with barely concealed mockery. Stock prices kept climbing, margin loans kept expanding, and the speculative bubble inflated faster precisely when the Fed was supposedly trying to deflate it through moral persuasion. The Fed's private correspondence from this period tells a story that's radically different from the official version. Officials knew the markets were ignoring them completely, and they understood they had no real tools to compel attention from institutions that viewed compliance as optional. They could raise rates at reserve banks, but member banks would just borrow elsewhere or tap alternative funding sources. They could sell government bonds to reduce reserves, but the fragmented system meant these operations produced unpredictable results across different regions with no way to coordinate the impact. The Fed was learning a brutal institutional lesson that authority on paper means absolutely nothing without enforcement power to back it up. This weakness wasn't some bureaucratic accident or oversight. Congress deliberately built a weak central bank in 1913 because the fear of concentrated financial power ran so deep in American political culture that lawmakers created an institution intentionally crippled by competing authorities and structural limitations. 12 regional banks received semi-autonomous powers. The Fed had no control over securities markets or investment banking, and no authority whatsoever over stock exchanges where the speculation was actually happening. The institution was designed from the ground up to prevent exactly the kind of centralized power it would eventually gain through the crisis to come. The gaps in authority were staggering when you examine them systematically. State-chartered banks operated outside the system entirely. The Treasury Department regularly overruled Fed decisions on major policy questions, and the gold standard constrained their options even when officials somehow managed to agree on necessary action. The Fed wasn't functioning as an independent central bank in any meaningful sense. It was more like a suggestion box that the Treasury occasionally glanced at when convenient. By 1929, Fed officials were desperately and acutely aware of their institutional irrelevance. Fed Governor Roy Young issued 18 separate public warnings about stock speculation between January and September of that year, and markets ignored every single one of them without consequence. Internal memos from this period read like therapy sessions. with New York Fed President George Harrison privately complaining to colleagues that the Fed had no real tools to address what everyone could see building. Regional bank presidents exchanged letters acknowledging their collective powerlessness in the face of market forces they had no authority to control. The Fed tried what officials called moral persuasion, which was essentially begging banks and brokers to show restraint voluntarily, and it failed spectacularly because moral persuasion only works when enforcement power backs it up. Here's the detail that should make you pause and reconsider the entire narrative. In late 1929, Fed officials privately discussed among themselves the idea that they needed some kind of shock to finally get congressional attention for meaningful institutional reform. They knew their structural weakness made them irrelevant to the markets they were supposedly overseeing, and they understood that only a genuine crisis would create the political conditions necessary for expanding their authority beyond the limitations built into the 1913 Act. They had no idea how massive that shock was about to be, or how dramatically it would reshape the institution they served. October 1929 changed everything in the span of a single month. The crash that Fed officials had warned about but couldn't prevent suddenly made them the center of national attention and transformed their institutional position overnight. Markets that had ignored Fed guidance for years were now desperately looking to them for answers, stability, and some kind of intervention that might stop the collapse. The irony is almost poetic when you think about it. The Fed's complete failure to prevent the crash became the primary foundation for arguing it needed dramatically more power to prevent future crashes. Then the bank failures started cascading through the system. Between 1930 and 1933, more than 9,000 banks collapsed across America in waves of panic that devastated local economies and wiped out the savings of millions. Each failure became ammunition in the argument that the fragmented system fundamentally didn't work and couldn't be reformed through voluntary cooperation. Proponents of centralization pointed to the thousands of state banks operating outside Fed control and argued that this fragmentation had allowed weak institutions to drag down the entire system through contagion effects. The solution they proposed wasn't less Federal Reserve power, it was dramatically and comprehensively more. Emergency legislation arrived in successive waves as each new panic generated fresh calls for action. The Banking Act of 1933 passed while bank runs were still making daily headlines across the country, granting the Fed authority over securities affiliates of member banks, territory that had previously existed beyond its regulatory reach. Each new wave of panic generated fresh legislation expanding Fed jurisdiction, and every expansion was carefully framed as temporary crisis measures necessary to prevent complete systemic collapse. But here's what you need to understand about how temporary powers actually function in practice. They have a remarkable habit of becoming permanent institutional fixtures when the organization receiving those powers also controls the narrative about whether the emergency has truly ended. March 9, 1933 deserves particular attention because of how quickly and dramatically it transferred authority under crisis conditions. Congress passed the Emergency Banking Act that day in a single legislative session, with many members voting on a bill they hadn't even had time to read in its entirety. Some representatives only heard the legislation read aloud on the House floor moments before casting their votes on what would become one of the most consequential banking laws in American history. That hasty piece of emergency legislation handed the Federal Reserve powers, including bank examination authority, emergency lending capabilities, and the ability to restrict currency withdrawals, that it had been seeking unsuccessfully for the previous 20 years. By 1933, Fed membership transformed from optional association to practical requirement through an elegant mechanism. Any bank wanting access to the new Federal Deposit Insurance Corporation had to join the Federal Reserve System, creating an implicit threat that made the choice obvious. Thousands of previously independent state banks suddenly came under Fed supervision not through persuasion or demonstrated regulatory excellence, but through the stark reality that uninsured banks couldn't survive in the post-panic environment that depositors now demanded. The Fed that couldn't convince banks to join voluntarily in 1928 now had them forming lines to submit applications because the alternative was institutional death. The Banking Act of 1935 completed the structural transformation in ways that permanently reshaped American financial governance. It centralized power in Washington and crushed the regional autonomy that had characterized the chaotic 1920s, creating the Federal Open Market Committee to give the Fed unified control over monetary policy for the first time in its existence. Previously, regional banks had conducted independent open market operations that created the policy chaos everyone had complained about. But now, 12 separate competing voices became one centralized authority, speaking with unified purpose. The Fed that emerged from the legislative frenzy of 1933 looked nothing like the institution that had been struggling for relevance and respect in 1928. But the transformation wasn't finished. In fact, it had barely begun, and what came next would matter even more. What happened in the years immediately following would turn a crisis management agency into the most powerful unelected institution in America, wielding authority that Congress never explicitly granted but somehow never revoked. The authority transfers that nobody noticed at the time became permanent architectural features. The temporary crisis measures evolved into the foundational structure of modern central banking. And most importantly, this period created the blueprint that would define how central banks expand power through crisis management for the next century. Here's what should genuinely concern you about this historical pattern. The exact same playbook is being deployed today with digital currencies, climate mandates, and emergency pandemic powers that somehow never expire when the emergency supposedly ends. The story doesn't end here. In the second part of this series, you'll discover how these Depression-era changes became permanent architecture, how the Fed went from controlling 30% of banks to dominating 80% of all banking assets, and most critically, how this exact pattern keeps repeating with every new crisis right up to today. The mechanism matters because once you see it, you can't unsee it, and that changes everything about how you interpret what's happening in financial policy right now. This is the foundation. The second part reveals how the structure was built and why it matters to your financial future.